Hi, I'm Billy Gwaltney, and this is the CYA Podcast. This show is for the physician who understands the importance of protecting everything you've worked so hard to achieve. Each week, I'll bring you tips and advice to help you cut through the clutter and misinformation and show you exactly what you need to preserve your income and way of life. If you're ready to achieve the peace of mind that only financial security can bring, let's get started. Welcome to today's episode of the Cover Your Assets podcast. This is Billy Gwaltney, your host, and I'm excited to be with you today as always. Today we're going to cover the coverage increase rider that comes with the MassMutual specialty disability policy. If it's structured properly, your policy would have the ability to increase coverage once you become an attending physician or as your income increases. If you're already an attending and you purchase, then your policy could include the ability to increase down the road again as your income continues to expand. This is a topic that we cover regularly as I'm working with clients, physicians across the country. The benefit of having a private policy is not only the initial purchase amount, but the ability to increase that coverage in the future, kind of like flipping a switch if it's done correctly, where there's no additional medical screening required, and the same discounts that are included on the base or original policy would be included on these increase or additional amounts as well. MassMutual, like a couple of other companies, has two ways that you can do the coverage increase component of the policy. The first one is called the benefit increase rider, and the other one is called the Future Insurability Option rider. The details matter for which one of these might be the best fit for your situation. A lot of clients like the benefit increase rider because the base policy is cheaper or less expensive if that rider's on there, because technically there's no fee for it. Okay, so it has to be an option that's elected when you purchase the policy, so it's not a given that it'll be on there. But assuming you have it on your policy, then you're not paying a monthly premium for that increase rider to be on the policy. And what it does is every 3 years over the course of your career that you're paying for the policy, you would be eligible to increase coverage based on your income at that 3-year interval. Okay, so just think of it as 3-year intervals. You're going to increase your coverage. They're going to take an updated snapshot. They, being the insurance company, will get updated information on your current salary before taxes, any long-term disability that your employer provides you, to determine if there's any additional coverage that you're eligible to purchase based on your income. Whatever that additional amount would be, depending on what state you're in, the cap for MassMutual is currently $15,000 or $20,000 per month of total coverage. So whatever that additional coverage is up to that cap, again, depending on what state you're in, you would be eligible to have that amount of coverage right away at that point based on your income at that time. The rider has a stipulation where whatever additional coverage you're eligible for, you need to accept at least 50% of that additional coverage, or they're going to remove the benefit increase rider from the policy. Okay, so let's just use round numbers. Let's say you're in training, you start out at $5,000 a month of coverage. You graduate, you don't increase it right away, but 3 years down the road, you're eligible for $15,000 a month of coverage based on your attending salary at that time. Then you can increase up to the full 15 right away. MassMutual is going to say that, hey, you either need to increase up to $15,000 or at a minimum increase to $10,000, which is 50% of the way between $5,000 and $15,000. Or we're going to require you to stay at $5,000 forever. And if you ever wanted to increase again, you would have to start from scratch, redo the medical screening and so forth. And so there are some guardrails, we like to say, around this particular option. But think about it, it's a trade-off, right? So you're not paying for the rider. In exchange for them, in essence, giving this to you, they call the shots for how and when you increase your coverage. Okay, so you're eligible for that increase up to 55 every 3 years over the course of your career. There are certain what we might call triggering events that would allow you to access additional coverage before that 3-year interval. One of those would be a significant change in income or loss of group long-term disability through an employer. A lot of times changing jobs can do that. So if you graduate from residency or fellowship, become an attending and you're in the first year or second year of the policy, you would not have to wait until that 3-year interval to increase. You could increase right away, but just know over the course of your career, you're going to be kind of in this schedule of doing it every 3 years. If your income hasn't changed during that 3-year period, you still need to go through the steps and submit your updated income information, or they're going to take the rider off the policy. Okay, so if you're not eligible for more, they'll communicate with you that you're not eligible for more, and the rider would just roll forward for another 3-year period. Your broker should be in touch with you about this. We communicate with our clients regularly about their coverage increases or on their policy anniversary, just making sure that your coverage is keeping pace with where you want it to be. And that's not just so an insurance broker can sell more insurance, although it's good to sell more, but still the primary driver for that is to make sure that if you become disabled, your coverage is where it needs to be. Because the policy benefit does not automatically increase just because you're making more money. You have to proactively do that. The other option that MassMutual offers is what's called the Future Insurability Option rider, or FIO rider. And this particular approach does cost more. So your base original policy that you purchase, if it has this Future Insurability Option rider on it, then the cost for that policy is going to be more compared to having the benefit increase rider that doesn't cost anything. You are paying an ongoing monthly fee for that FIO rider, the Future Insurability Option or FIO rider. In exchange for paying that fee, you can increase your coverage on any policy anniversary whenever you want to, based on your income at that particular point. You would be eligible to increase actually up to age 60. How much you can increase changes as you get older, but you'd be eligible to increase to age 60 as your income goes up. Again, assuming you're not already at their cap of 15 or 20,000 of coverage, depending on what state you're in. That's the maximum they'll allow anyone to have. And so in mentioning this, some clients, obviously, I think a lot of our clients are driven by cost, especially when they're in training and looking to buy coverage. They want to keep expenses at a minimum. And so it's easy to gravitate to the benefit increase rider that doesn't cost anything. And most people are usually ready to increase coverage about every 3 years, if not sooner, especially early on in their career. So they don't tend to find that every 3-year rule cumbersome or problematic. But there are others that want to be able to call the shots on when and how they do their coverage. And so that's where the Future Insurability Option rider would be preferable, understanding that it'll cost more to have that up front. There is kind of an exception to where the benefit increase rider would not be ideal. And that is if you purchase your coverage. So as a general rule, you're covered wherever you move within the U.S., and a lot of times anywhere in the world, unless you have a foreign travel exclusion, you'll be covered while you're there or while you move around. The coverage is private and goes with you. So as long as you pay the premium, you keep it. But the rate that you pay is governed by the state you live in when you buy the coverage, okay? And if you buy a policy with MassMutual and it has the benefit increase rider on it, let's say you buy it in Maryland, you're going to pay a Maryland rate. But whenever you finish and you graduate, you're going to move to California. For any client moving to California, it's important that they understand that you're just going to pay more for California if you're in California when you buy it. Ideally, you'd want to buy whatever coverage you're going to get, at least disability coverage I'm talking about in particular here, in whatever state you're in before you get to California. And then you'll be covered in California, but you'll always, in this example, that you would always pay the Maryland rate if you bought it in Maryland. The exception to that is the benefit increase rider. When you go to increase coverage, if you're in California when you do the increase, you will pay the California rate for that additional coverage. Your base, let's say you started at $5,000, that would always be based on the state you bought it in before you got to California. But the additional coverage is going to be based on California if you live in California when you do it. And so on average, the California rates are probably 20 to 30% more. You'll notice that. It's probably not going to keep you from retiring or sending kids to school or what have you. But you will notice a little bit of sticker shock when you go to increase coverage that there's the coverage cost is going to be higher than the proportional amount of coverage that you're adding on. And so if you think you're going to move or know you're going to move to California, and you want MassMutual, you would probably want to consider the Future Insurability Option because that would always be based on the state you bought the original policy in. So when you go to increase coverage, in California, if you have the FIO rider that you're paying an extra fee for, that would be based on the state you bought the original policy in Maryland, in the example I gave. So even though you live in California, you would increase your coverage in California, but it'd be based on the Maryland rate. With the benefit increase rider, it's going to be based on California. I know this is a lot to kind of throw at you in a podcast. This at least should get you thinking and hopefully along the right course. And you would want to verify the details of this before you decide. I'd be happy to help you in any way I can. Feel free to reach out to me anytime to arrange a conversation or with any questions. My number is 704-270-2376. Again, that's 704-270-2376. Until we meet again, this is Billy Gwaltney. Thank you, as always, for carving out a few minutes.
This is thepodcastfactory.com.